Welcome to BD Daily Finance News Podcast, your daily briefing on finance and investing. It's 2026, April 13th, and today's theme is simple. Oil popped back above $100, and markets immediately started acting like someone yelled fire drill in a crowded theater.
Nothing says calm Monday like oil at $100 and everyone refreshing their portfolio like it's a heart monitor. If your retirement account had a mood ring, it would be screaming.
We'll cover three things fast. First, why oil jumped above $100. Second, what that did to stocks and yields. Third, how inflation stories like India's can foreshadow what households feel. Plus a quick crypto reality check.
Okay, explain it like I'm 5, but a 5-year-old with a Costco membership. Why did oil go back above $100? Did someone spill a barrel into the ocean of supply?
The headline driver? U.S Iran peace talks failed, and multiple outlets reported escalation risk around the Strait of Hormuz, including a blockade narrative. When traders think a key shipping choke point might get disrupted, they bid up crude because future supply looks less reliable.
So it's not that we ran out of oil today, it's that the market is pricing in the possibility of oil traffic jam, and everyone panic orders like it's the last pack of toilet paper.
Exactly. Finance version, oil is a global input, and price is partly a fear premium. If the route risk rises, insurance, shipping, and delivery uncertainty rise, so the price can jump even before a single barrel is actually lost.
And for normal people, that's gas, flights, delivery fees, and your favorite snack magically going from fun little treat to luxury item. Also, companies sneak it into prices like a ninja.
Now the market reaction. Bloomberg's Markets Wrap described stocks falling and yields edging higher as oil topped 100. That combo often means investors are repricing inflation risk and uncertainty. Equities get hit, and bonds can sell off if people expect higher inflation or fewer rate cuts.
Wait, my safe bonds can drop too? That feels illegal. I was promised bonds were the comfy couch of investing, not a trampoline.
Bonds are safer in default risk, not in price volatility. If inflation expectations rise, investors demand higher yields. Higher yields mean existing bond prices fall, especially longer duration bonds. It's basically like your old coupon is less attractive when new bonds pay more.
So the market is saying oil up, inflation may be up, central banks maybe stay grumpy longer. And then stocks hear that and faint dramatically onto a chaise lounge.
That's the clean mental model. Actionable angle. If you're a long-term investor, you don't trade your entire plan on one headline, but you can stress test. What happens to your monthly budget if gas is 15% higher for 3 months? And what happens to your portfolio if rates stay higher for longer?
Speaking of budgets, India's inflation picked up, right? Bloomberg said energy costs were lifting inflation. That's basically oil prices travel internationally like they have a passport.
Yes. The story, India's inflation edged up in March as the Middle East situation lifted crude prices and squeezed supplies for industries. The finance behind it is pass-through. Energy is an input into transport, manufacturing, and food logistics, so higher energy can show up in broader consumer prices.
So when people say inflation is cooling, oil shows up like, not on my watch, and then your grocery receipt starts doing stand-up comedy at your expense.
Quick crypto check. CoinDesk noted crypto markets stalling as oil surged past 100. In risk-off moments, crypto often trades like a high-volatility risk asset, not a pure safe haven. Liquidity tightens, people reduce leverage, and price action can go sideways or down.
So Bitcoin isn't always digital gold. Sometimes it's digital, I'm stressed, I'm selling whatever moves. I disagree with the maximalists, but I do agree with one thing. It's a mood ring for liquidity.
Let's end with 3 practical moves. 1. Household. Set a temporary energy buffer in your budget for fuel and utilities. 2. Portfolio. Rebalance back to your target instead of panic selling. If energy exposure is 0, at least know that's a bet. 3. Rates. Be cautious with long-duration bond risk if inflation resurges.
And here's my disagreement. You said don't trade headlines, but if oil stays above $100, I'm not waiting politely. I'm checking my spending, locking in any reasonable travel plans, and yes, shopping my car insurance and gas rewards like it's an Olympic sport.
Fair correction. Don't trade your entire portfolio on headlines, but do act on the parts you control quickly: cash flow, fees, and risk exposure. If this helped, subscribe for tomorrow's briefing and drop a comment. Are you hedging, holding, or hunting bargains?